My name is Anthony Fatsies, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again. I hope you enjoy. Hello, everyone, and welcome to another episode of the What the Finance podcast. And on today's episode, we're talking to James Fok, who is a financial markets professional. And we're talking about his recently released book, The Financial Cold War, A View of Sino-US Relations from the Financial Markets. And just on to my first question, James, what was your influence for writing the book?
Look, I kind of spent my entire career in financial services, and particularly over the last 10 years, at an intersection of financial markets and policy and geopolitics, working at the stock exchange in Hong Kong. And, it gave me certain insights into the whole financial system and how that is operating, and how that translates into day-to-day types of day-to-day lives and day-to-day livelihoods for a lot of people. And I felt that there are a lot of parts of that weren't particularly well understood. And so that's really my motivation for writing the book.
Yeah, it's interesting. And I guess, have you seen sort of quite a few changes over those past 10 years? I guess we'll talk about later with the rising of maybe conflict, but what changes have you seen personally during that time?
Well, I think over the past 10 years, we've really been sort of living in a rebound of the global financial crisis in 2008, and I think China has made huge further steps in internationalizing its capital markets, but a lot of other parts of the financial system around the rest of the world haven't yet adjusted to the new realities that exist. It's creating a huge number of imbalances, which are having real life consequences for a lot of people.
Yeah, and I think you mentioned that in the book with, there's that wealth gap both in China, especially Hong Kong, I think, and then in the US as well. And from when I was reading the book, I was quite shocked how there's such a divide between Hong Kong and China, mainland China, in terms of their financial systems and how they work. It's not really connected, which I'm sure, can be quite challenging, especially when you're interacting between the two.
Well, I mean, if you're sitting in Hong Kong, I mean, we've ridden, over the past 30 years during the course of the opening up of China, a huge wave that actually has been fantastic for many people in Hong Kong. Unfortunately, there are also people who haven't done so well out of that, particularly our manufacturing sector, our export manufacturing sector, which used to be very strong. There was no way that Hong Kong, given its small size, given its cost base, could ever compete, and a lot of people have been displaced. And that's a similar story around a lot of parts of the rest of the world.
Yeah, definitely. I think you mentioned how that also, Hong Kong, pegged to the US dollar, have to really follow their monetary policies, which can really impact. And that's why we're seeing, massive price increase in property throughout Hong Kong and everything like that. But I guess we'll go to the book, and while you talk about history quite a lot, it's very in-depth analysis of the past, how it really relates to the future. The story really starts at Bretton Woods, I guess, and the US dollar taking over the pound as the world currency. So while it's different now, the US dollar is still sort of the reserve currency of the world. What power does this give the US? Maybe how has this sort of influenced the conflict we're seeing today?
Well, I think probably it's useful for me to first of all kind of give your listeners a kind of sense of what the financial Cold War is, because I think although it sounds kind of big and dramatic, what it is, it's really an invisible conflict embedded in the structure of the global financial system and national financial policies, which has been driving an increase in wealth and income inequality all around the world. And that we've seen more recently has been spilling over into serious social tensions and international conflicts. And so when you look at what the financial Cold War has generated in terms of your question, gradually that's spilled over into what I would call a geoeconomic war or conflict, whereby countries are using their financial heft and financial tools as a means of containing or limiting the influence of strategic rivals. And so the US is probably the most powerful country, or at least it has the most powerful geoeconomic arsenal, given the global role that the dollar plays and the influence that the US has over the dollar payment systems around the world. And where you've seen this being used is in terms of the imposition of sanctions around the world on US rivals. Now, some parts of that I think are perfectly legitimate. I mean, we certainly don't want to see widespread terrorist financing and so on and so forth. But the US has also used its influence over the dollar system to pursue its strategic objectives, where it's seen even by US allies as being not such a legitimate use of its power. One good example of that is when in 2018 the Trump administration pulled out of the UN-backed Iran nuclear deal against the wishes of Germany and the other UN Security Council members that were also signatories to that deal. There was very little that anyone could do, just because the US just has this massive power over the financial systems and over the dollar payment systems.
Yeah, and I found that quite interesting where you said that they don't, normally in the past you'd have to have your allies and everyone would have to sort of go the same direction. But now, because the US has such power through the dollar, they can just do it by themselves without actually talking to any of their allies. And then, that brings in companies as well. I think you said Standard Chartered had a massive fine because they were using US dollars in Iran, as well as I think it was BN Paribas or something like that, 13 billion or something like, crazy numbers. So just that control that they're having, not just on the US, but also the world in terms of how they can interact with other countries, really impacts them. And you mentioned as well, it doesn't impact it impacts the people in charge, the people in power, but also impact the people as well, the country, dramatically.
Look, the financial Cold War isn't just about the dollar. There are quite a number of other aspects, but one of them being the international tax competition that you've seen as trade and investment around the world has globalized. All countries want to attract investment into them. And the problem there is that because capital is inherently much more mobile than labor, people don't want to tax, or countries haven't felt able to tax capital as heavily as it's taxed labor. So it's ended up in these kind of slightly balmy tax systems where corporations and very wealthy individuals are paying much lower rates of taxation than middle-class workers. And over a period of time, this has been generating significant tensions, which we've now seen spilling over into international conflict, particularly when it's been fanned by the flames of populist, nationalist politicians.
Yeah, definitely. I think, you can say as well, after the financial crisis, just the quantitative easing that was pumped into the economies, it's just actually, widened those divides, hasn't it? It's like, because let's be honest, capital, stocks and, most assets have gone up in price. So that the people who've owned them have really benefited the most, I'm sure, in most countries.
Yeah. And I mean, the monetary policies that central banks have pursued since the financial crisis in 2008 is a whole other topic area where really there's been because people haven't been able to rely on raising taxes, they've had to come to rely much more on monetary stimulus, which has had certain unintended consequences vis-a-vis creating far sharper levels of wealth disparity.
So in the book, there was a quote which I thought really stuck with me. It was from George Kennan, who was a US diplomat, where he stated that despite the US and sort of Soviet Union having fought in a war, they had that friendship. There was really little connecting them other than that. So, not much trade, not much relationship in the past. Whereas the relationship between the US and China is very different. It's very interconnected, as you said, financially, as well as, through trade. So do you see it? People have said there's potential for decoupling of each economies and each financial systems. Do you see that as possible, or do you think that would just be outlandish?
Okay, I think that this is one of the biggest issues that I take with people who are characterizing the conflict between China and the US as a new Cold War, or even more crazily, in my mind, are actually suggesting that a new Cold War would be a good thing because it might help America to confront its domestic political dysfunction. I think those sorts of views, frankly, on the facts, are just rather insane and certainly very dangerous. When you look at the level of interconnectivity that you have today between not just China and the US, but both countries and many other countries, it's patently obvious that a decoupling would be hugely economically damaging and hugely destabilizing, not just to China and America, but to a lot of other countries. And the consequences of that, if you look beyond the economic sphere to what that means in terms of social stability, the stability of regimes, the potential for conflict that creates. I think it's something that, while not impossible, I think would be just something that would be crazy to do.
Second part of the book, it really focuses on the relationship sort of between China and the West, and I guess its evolution over mainly the 20th century. So I don't know if you want to expand on that, maybe so people can sort of get a greater understanding on, how we've gotten to this stage with China. And I guess, the last 50 years have been incredible, maybe before that as well, and, why that's all happened.
Look, I think, a lot of people who have come across in the West, they have a certain view of China. And I think a lot of those views are tied to, frankly, views of communism and the Soviet Union, back in, the Cold War period. And the reality is quite different. And what I wanted to do in the book is to give readers a real sense of the environment out of which policymakers in China have come from, and the contexts in which they pursued the sorts of policies that they pursued, which actually, if you look on the facts of it, over the last 40 years have been extremely successful in driving both economic and physical development of the country, and a fairly widespread level of prosperity that you've got now.
Yeah, definitely. Because, you look at the last 40 years after Mao, where they've come from. And I guess, this might be generalizing, but, that may be why a lot of people are happy with what's happened, just because, they've seen that impact of what the last 40 years have brought to so many people in China. I don't know if that's true or not.
I think that's certainly true. I think, if you look at the average person in China today, he or she is far better off than they were 40 years ago, 30 years ago, 20 years ago. And you know, in that sense, you know, I think there's a fairly widespread recognition that the government's done a pretty good job. That said, I mean, of course, you know, that there have been mistakes, and you know, I think one of the particular concerns that I highlight in the book is that, you know, what's worked in the past, given where China's now gotten to, probably won't continue to work in the future, and that the system needs to adapt to those new realities. And particularly, I think that the success of the Chinese model has been that it's actually, in the 1980s, they actually issuing a lot of foreign debt. And so, you know, when the Asian financial crisis came along, they weren't swept aside along with a lot of other Asian emerging economies at the time. But also, you know, when you look at how they've actually managed to achieve the level of investment in infrastructure that they have done, it's largely been through holding down consumption and harnessing the savings of the Chinese population in order to invest in the infrastructure and the development of the economy. But you know, that, although it's been very successful, you know, you can't continue to invest and build more and more houses and buildings and industrial capacity forever, because at some point you get past the point at which, you know, it's efficient to do so, and it results in a huge amount of capital misallocation. And what I believe that, you know, Chinese policymakers need to do now is to move away from that top-down state planning model for allocating and pricing capital, and allow the market to play a bigger role in those things.
And I guess, do you see and you could say this is linked to the wealth divide we've seen over the past year or so, you know, the 3 red lines that have been implemented, and, you know, an impact on, you know, the housing market in China. So do you see that's their continued approach of coming from the top down? And do you know, I guess you could say there are lots of problems with what's happening there, but do you think they should let it go and let it sort of deal with itself? Or
look, I think, you know, a lot of people look for very dramatic moves. I don't think dramatic moves are something which are actually in either China's interests or in the interests of the rest of the world. Back in 2007, you might recall, you know, that there was a through train scheme touted to allow Chinese investors to come and freely invest in Hong Kong stocks. And what that drove was a massive bubble or run up in the Hong Kong stock market, and then a subsequent crash. You know, the reality is that, you know, the Chinese banking system holds around about $35 trillion in savings. This is the largest untapped capital pool in the world. And if that money all rushes out at once, it is not only potentially destabilizing to China, but it's also potentially quite destabilizing to the countries and economies that receive it. So I think in that sense, a gradualist approach, which is what the Chinese government has broadly been doing in the opening up of its capital markets, is a sensible way to go. But, you know, in terms of the pricing allocation of capital, it's not just money coming out of the country, but it's also how money is allocated within the country. And, you know, there's still quite a heavy hand of the state involved in that process. And we're getting to the point where, given the complexity of the economy, given the complexity of the types of business models that are being created today, is gradually getting beyond the ability and capacity of the state to really make those decisions on behalf of businesses.
Yeah, definitely. I guess sort of when you mention those, say, like there's just so much savings, is that sort of something that's cultural? Is that something that's been just in the rules in terms of spending? Why is that there, that $35 trillion worth of savings?
Well, I think people tend to compare it with the US. I don't think the US is a particularly good comparison because actually the US tends to overconsume, and a lot of that is rooted in what the dollar system and what that drives in terms of needs and behavior. But there's certainly aspects of Chinese policy which have limited consumption. One of the big limitations is that the social welfare system is still relatively undeveloped. So people effectively need to self-insure by holding more savings than they otherwise would. But it also comes down to labor policies, the level of wages that workers get paid, industrial policies like that. And so there are other aspects of Chinese policy which have contributed to a very high savings rate. I think the dollar system is also I think one that's been significantly at play here, because in essentially trying to maintain stability against the US currency, China has, for a very long period of time, effectively managed its exchange rate versus the dollar. And so where the currency has been artificially undervalued against the dollar, that's limited Chinese consumers' ability to buy imports, which is one of the things that's driven the imbalances that you've seen in that trade relationship.
Yeah, and do you feel like that's maybe a reason as well why it hasn't, even though it's the second largest economy, it hasn't really, the yuan hasn't really been used that much in terms of international trade? So do you see that as maybe one of the reasons that the US dollar is still king, and euro and I think the pound is still used more than the Chinese currency?
When you look at the situation for companies that are interacting with Chinese counterparties, if you receive renminbi in payment for your goods or services overseas today, there's still very few Chinese renminbi denominated assets for you to be able to invest in. So you're less likely to be willing to accept them in trade. You know that if you get dollars, there are all sorts of things that you can deploy that capital to, or those funds to. If you're a counterparty dealing with China, if you get renminbi in the offshore market today, there are very few renminbi denominated assets for you to invest in. Whereas if you receive US dollars, there are any number of securities or other ways for you to deploy that money in US dollars. And so I think for China, if they're going to internationalize the renminbi, they've done a lot of work on the settlement systems, the payment systems, but in order for them to truly internationalize the renminbi, they really need to allow a greater number of renminbi denominated securities to build up in the offshore market. And the most obvious way to do that is by allowing Chinese investors to invest more abroad, because inevitably, if that capital can come out of the country, then there will be demand from overseas corporations, governments who are willing to issue debt or other securities in renminbi in order to attract that investment.
Yeah, it's interesting. And do you see that something that is realistic? And I'm not sure. Is that something that they're looking to do? Or?
Well, look, I think the Chinese policymakers are very acutely aware of the harm that the dollar system has done to the US. So I think a lot of people look at the US's global role as being a blessing for the US, but that's not necessarily been the case, because very simply, in order for the US dollar to serve that role, it's meant that the US has had to continuously run balance of payments deficits versus the rest of the world. And when the US economy isn't growing at least as fast as the rest of the world, that means that you get into ever higher levels of debt, which is where the US sits today. But even on a kind of different segment of society analysis, if you're a wealthy shareholder of a large US corporation that's been able to offshore part of your manufacturing to lower cost centers of production because the dollar has been structurally overvalued, you've hugely benefited from this system because it's allowed you to lower your costs, increase your profit margins. But if you've been a US manufacturing worker, it has not been such a good thing for you. And one of the key points that I've sought to highlight in my book is that actually the dollar system today is not working to the benefit of the majority of people in the United States.
Yeah, definitely. And I think, as you said, there was also laws involved where, overseas capital was treated differently to capital in the US, and that really encouraged people to actually, as you said, manufacturers to go overseas. And I think that's what we've seen today, where, US is a very small manufacturer compared to what it was in the past.
It's still sizable, but I think certainly it's been damaged because of the structural overvaluation of the US dollar, and also the fact that the US having to continue to export US dollars has encouraged part of the overconsumption that you've seen. It's allowed US consumers to spend beyond their means, but it's also particularly enticed the US government to spend far beyond its means. And while financial markets can stay irrational for longer than you or I can stay solvent, that they're not going to stay irrational forever. And at some point, there is likely to be a reckoning. And what I believe and what I say in the book is that the US should participate in proactively reforming that system before the power to make those reforms run away from it.
Yeah, definitely. And in the book, you mentioned, increasing taxes as a way to sort of control, say inflation and reduce the debt, which could be a massive thing as well. And, at the end, you really mentioned the IMF sort of special drawing rights, SDRs, which could be a replacement, I guess, for the US dollar in terms of providing liquidity around the world, and that may be beneficial for the country. Do you think that would be a resolution in the short term, or do you have any other suggestions on ways that, that maybe the US could, I don't know, would you say that it'd be beneficial for them to leave and sort of, I guess, for the US dollar to not be the world currency?
Well, I think that there's a precedent for this in what happened with pound sterling after the Second World War, and I think that this is not directly applicable in the case of the US, because the level of imbalances are much greater today than they were then. But I think it is instructive in terms of a possible path towards resolving this. And really, it first of all comes down to having a level of political consensus that the dollar can no longer continue to play this role. It so happened that after the Second World War, Winston Churchill was voted out of power and a Labour government came into power in the UK. And while there were very strong constituencies who would have liked to have seen the pound sterling continue to play the role of the global reserve currency. And at that time, pound sterling accounted for 87% of global foreign exchange reserves. The reality was that the choice that the government faced was that if the pound was going to continue to play that role, then the country would have to absorb all of the financial imbalances from the rest of the world, which meant that UK workers would have found themselves displaced because the pound would have been overvalued and hence uncompetitive versus other trading partners. And so the UK government at the time imposed capital controls. They went through a series of several quite significant devaluations of the pound. During the course of a 30-year period after the war, that the UK was also supported by the IMF and other countries in terms of winding down sterling's role in that position, i.e. those countries didn't suddenly dump their British gilts and destabilize the market. And there's a bit of game theory in this also, because the reality is that if they suddenly en masse dumped those, then they probably would have been worthless anyway. And so it's a process that shows that there's a level of political backing that's required in order to do this in the country that needs to whose currency is playing that role. And then it also needs to be a managed process in which other countries cooperate and support in unwinding the role of that currency.
Yeah, and it's hard to get anyone to agree on anything these days. So you could say that would be quite a challenging thing, especially with how complex the monetary system is today compared to 70, 80 years ago.
Oh, that's absolutely the case. I mean, in those days, you didn't have anywhere near the size of the derivatives markets and the repo markets and other aspects of the financial system today that you will have to contend with now.
Yeah, definitely. So say if they were to make those changes over the next 30 years, do you think that would potentially help to, stop a financial cold war? Do you think there'd be any other changes that would need to be made? I know you've mentioned a few in the book, if you want to mention them.
Well, I think the first point that I think policymakers, when they sit down and rationally think about it, need to realize is that China and the US and other countries are so intertwined that they each have a significant interest in the social and economic well-being of the other. And so this is not a contest in which if the other side does badly, I'll do a little bit better. If the other side does badly, actually, this is probably bad for me too. And so they need to work together and to cooperate. And the financial, dealing with the financial aspects of this are going to be incredibly complicated. But I do think that given the descent of the rhetoric into fairly unconstructive territory in recent years, I think that the countries need to start to rebuild a level of trust. First of all, they need to start talking and not just blasting at each other through social media and the press. And I think it would be helpful if leaders took a step back and really showed each other a level of respect, which has been fairly lacking in that relationship of late.
Yeah, definitely. I think those are some great points. I know as an Australian, it's sort of seen the last few years, the escalation is crazy to see how quickly it can happen from, quite good friends to, not enemies, but obviously there's a little bit of angst between the two countries.
Yes,
But
that's a nice way of putting it.
yeah, definitely. So, James, thanks so much for joining the podcast to talk with me. And just on to my last question: what is one message you'd like listeners to take away from the interview, and maybe take away from the book as well?
Well, I think the things that I took away from my research and writing the book were actually fairly simple points. First of all, that for each of us and our loved ones to enjoy a level of security, we have to have care for the security of others. Social stability and progress that we all want to see that depend on being able to offer a level of fair access to opportunity to everyone in society, and a balance of incentives and community support so that each person is able to find some form of fulfillment. And I think that the third and probably most directly relevant point to those in financial markets is that markets are a really valuable tool, but governments play a critical role in the allocation of society's resources, and particularly in balancing the interests of different segments of society, and also in balancing the interests of current and future generations.
James, thank you so much for joining the What the Finance podcast talk with me today. So if anyone wanted to buy the book, obviously there's Amazon. Is there anywhere else? And I guess if anyone wanted to see more of your work online, where would the best places for that be?
The book will be available from most major booksellers from the end of this month. And if you want to find out more about me or about some of the past articles that I've written, you can go to James A Fok, JamesAFok.com.
Perfect. Awesome. I'll put that down in the description below so everyone can find everything and buy the book, hopefully. So James, thanks again.
Thank you very much, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.